Welcome to today's update video called Breaking Down Barrier Income. Breaking Down Barrier Income is a monthly series featuring Simplify's Barrier Income ETF, ticker symbol SBAR. SBAR launched mid-April 2025, just over 9 months ago. Today we'll be reviewing the performance for the month of January 2026. We believe Simplify is transforming the structured note experience by providing outcome-based solution and a liquid ETF wrapper. My name is Jeff Schwarty, Chief Equity Strategist at Simplify. Today I'm blessed to be joined by Emilio Frede, Lead Portfolio Manager for SBAR. Welcome, Emilio.
Thank you, Jeff. Hi.
Great to have you on board. So today we're going to review performance, talk about the distribution yields, remind investors the use case, operational benefits of SBAR, and then we'll talk more deeply about positioning correlations and the income realization of SBAR. So let's go through. Let me share my screen here. Okay, so we're reviewing January 2026. So our distribution rate at the end of the year 2025 was 12.91%. We've been distributing 28 cents a share since the launch of SBAR in April 2025. The SEC yield is 3.51. That's down a little bit as rates continue to normalize in the marketplace, and we continue to have that nice just under 13% distribution rate. As far as performance is concerned, since inception up 14.4% with an annualized realized volatility of about 10.5%. It's a pretty good ratio. As you see on this chart, we're comparing SBAR's performance to the Bloomberg Ag Index. It's a broad-based bond index. You'll see we've done quite well relative to that index. It's a nice upward trending slope to the right. We did have a little bit of a pullback in November, which we reviewed last month. That's all related to government shutdown. That all got resolved, and we're kind of up on that the trajectory that we've experienced since inception. Any comments about performance, Emilio?
Yeah, Jeff.
So the audience.
Yeah, so I think the new year started with sort of the same dynamics that we saw at the end of 2025, right? These episodes of short-lived corrections in the equity market with modest to large volatility spikes, followed by these quick market recoveries and volatility crash. As we already talked about, this is a great environment for SBAR. So performance-wise, in January, SBAR was up roughly 80 bips, with SPX up about 1.4%, which is in line with the sort of observed historical beta of roughly 0.6 between SBAR and SPX, right? The thing to highlight in January, Jeff, is perhaps the fact that equities went up while overall volatilities also moved higher, right? The reason for this phenomenon, SPX up, VIX up regime is typically a combination of two things, right? On the one hand, we have a strong underlying equity fundamentals, right, driving risk taking and upside, which in the case of January was basically strong macro data and solid tech earnings in the AI space and so on, combined with elevated macro political or policy uncertainty that keeps demand for hedging high. In January, this was basically driven by the Fed path ambiguity, along with Trump-related trade and policy headlines, right? Yeah. That's a rather unusual but interesting dynamic to keep an eye on. But it's ultimately helping us in SBAR with both the callability feature, right, for existing positions, and also with premiums for new positions, right? We keep getting called away on other positions, but at the same time, we are reloading risk into higher and higher premiums, right?
Yeah, on that note, Emilio, it's a really important thing. We want the positions to get called because that's an annualized premium we sell at the beginning of the contract. And if it gets called, we are able to return stack that premium to additional positions in the portfolio. And I also want to remind people that the performance and the yields are really driven by equity volatility. So in a higher equity vol environment where the market's trending upward, you kind of get the best of both. You get juicier yields from selling the options, but you also get the positions called. So kind of the best case scenario is increased equity volatility with an upward trending market. So can't stress that enough, is that we welcome the auto calls for the product because that allows us to return stack those premiums. Okay. All right, so just as a use case, auto calls are becoming more popular with investors. I think there's several reasons. Number one, you get the nice double-digit yield 12.9% on the distribution rate. You've got this barrier level of 30%. So the worst of the three indices would have to go down more than 30% at expiration. So it's a European knock-in option at the maturity date of each of these contracts, which is 1 year. If the worst performing of the three indices, S&P, NASDAQ, Russell, finish below 30%, then you participate in that drawdown. If it's down less than the 30%, then you have zero drawdown from that position. And we like to think of it as an alternative to bonds because it does provide that income, but the drivers of the yield is going to be really equity volatility. So we think it's a really good, checks a lot of the boxes for investors looking for income, some corridor of barrier protection, and then an alternative to traditional asset classes. Use case, nothing's changed from previous conversations. The biggest thing is really the continuous liquidity. Investors that have bought annuities or other sort of asset classes that have lockups, we do not have that in SBAR or any of our barrier income products such as XV and XXV. Operational efficiencies, we have calls on a regular basis where advisors just hate the ability or the requirement to babysit these positions in a structured note. So we do that operational efficiencies and we give that time back to those investors so they can focus on other parts of their business. Fully transparent, we provide reports on a weekly basis, and research shows that it's lower fees than traditional structured notes. Two ways we're enhancing the income for investors: the callability. This is what we talked about a moment ago. The auto call feature allows investors to enjoy additional yield if all three indices are above the initial value. I think SBAR since inception, Emilio, we've had like 58 positions in the portfolio, and like 56 of them were called the first time they were eligible to be called, and the other two were called maybe a month later. So great environment for SBAR. We think it's a good position for folks to participate to try to get some income. And the worst of, really, you get a higher yield because you're looking at the worst performing of S&P 500, NASDAQ 100, and Russell 2000. Okay, let's go into my favorite slide in the entire deck is the positioning visual. So on the bottom part of the visual, we have a record number of auto call positions. Distance to barrier on aggregate is just over 30%. About half the fund is eligible to be called. And then on the x-axis, we have the notional weights of various positions in the portfolio. And then the dashes at the top represent the best, worst, and average performance of those three indices. The point of the visual that matters the most is the bottom point. So any comments here, Emilio? I feel like this is a very consistent profile where we diversify the positions. We've got a nice distance to breaking the barrier of each of the positions in aggregate. Any comments here, Emilio?
No, I love this slide. I mean, I think you did a good job summarizing. There is a lot going on here, right? A lot of information, but I think it's a great summary. We can talk about hedging if you
Sure.
like, Jeff.
Yeah, let's do that.
As we already discussed in previous videos, Jeff, we have this ability to buy these low cost hedges in the portfolio, right? Via mostly vanilla loan puts on any of the three equity indices, SPX, NASDAQ, and Russell that we have in the baskets, right? Only when we believe there is an opportunity to get high amounts of notional for minimal spend, covering around 2 to 3 months of protection with strikes relatively close to our barrier levels, right? Roughly 20 to 30% out of the money. We believe these hedges can have very attractive potential payoffs that could help the portfolio navigate periods of market stress. Now, as we just mentioned last month, right, in December, we took advantage of the lower premiums to buy an SPX put expiring at the end of February, roughly 20% out of the money and 100% notional coverage at the time. Mm-hmm. However, given this higher volatility environment in January, we decided to wait to add a new hedge in the portfolio, right? So at the moment, we continue to have our February hedge, and we hope to add a new one, when the type of protection that we like becomes cheap again, right? So we don't want to force any of these hedges into the portfolio. So we prefer to wait. Once these hedges become attractive and cheap enough, we will add a new leg into the portfolio, right?
Yeah, Emilio, I think just real quick on that. This is really a differentiator between our approach than our competitors, but the 20% of the money. So if a markets were to start to sell off, let's say 15%, that long put option would start to provide some level of protection the closer you got to the strike. even though
Mhm.
we have a strike in the overall portfolio of 30% for each of the barrier options, this is kind of a insurance policy before you actually approach the barriers. So talk a little bit more about how that position might perform as we have a drawdown. We're not predicting that, but if we were to have a significant drawdown of how would that position help
Well,
the
I mean,
value?
ultimately, we're going for convex payouts, right? It's a
Mhm.
convexity position, right?
Yep.
So we're going to buy something very cheap. Convexity in simple terms is you buy something very cheap and then you sell it for a high price, right? So these positions have the potential to go 15, 20, 30x, right? As they approach this, as the market approaches or the underlying approaches our strikes, right? So
Yep.
yeah, I mean, as you were mentioning, together with, volatility going up, which also helps these positions, right? Increase their value. So yeah, I mean, we don't have to get all the way to the strike for these positions to start, offering protection in the portfolio. It could
Yeah.
be very well, 5%, even 10% away from the strike, already seeing convexity paying off. Yeah.
Yeah, I kind of think of it as like flood insurance. Everyone has property casualty insurance on their home, but this is like an extra level of protection. But yeah, thank you for
Mhm.
your insights there, Emilio. Let's dig a little bit more into what's happening with rates. We've certainly seen a couple cuts in 2025. Who knows how many in 2026, but maybe any comments here on how rates might impact the overall distribution yield, Emilio?
Well, I mean, once again, as you mentioned before, right, Jeff, like the total yield of SBAR is just it's coming from these two independent components, right? The income from the barrier puts and the treasury yields. So
Yep.
this slide once again is just highlighting the last few rate cuts and how that would normally, reduce the yield coming from that component. But as we know, we had a favorable market environment, since we launched SBAR, right? So the yield that we've been generating from that component, from the barrier put selling, has been on the high end of the spectrum, right, of the range. As we will talk about on the last couple of slides, I think around 12% yield in just under a year, right, 10 months. Therefore compensating for the reduction in rates, which is the other component, right? Two independent components.
Yep.
Um, so this is just to highlight, a reduction from that, the yield
Yeah.
coming from that component.
Yeah,
But
we would expect as rates normalize, who knows how many, but that
yeah,
component of the income would drop proportionally. And then really the real driver of the income is really volatility, equity volatility. So here we're showing three different equity
yes,
indices with a 1 year realized vol of 80% money.
yeah,
And
and
so you'll notice these spikes in volatility coincide to some headlines that we were experiencing. So November was government shutdown. April last year was related to tariff tantrum. Any comments what you're seeing day to day, Emilio?
well, I mean, mostly, the last month, right? Recently in January, we can see, as we talked about, 1 year volatility is coming up, due to, multiple like sources of uncertainty, macro level reasons, or, more trade policy headlines and so on, which once again helped us, generate premiums. We saw premiums 20% higher than the average since we launched the fund, right?
Yep.
So that was a great environment combined with, the market being up and so on and so forth, as we already discussed, right? Um, but yeah, I mean, this is one of the main sources of risk premia in the baskets, right? In the worst of baskets, together with the correlations that we will talk about on the last slide. Um,
Yeah, just to give people a little bit of color, in September here, I think we sold a barrier option around 3.5%. The one we sold in November
right.
was like 4.8%. So
The highest, I
as
think, right? In November,
yeah,
yeah.
as vol increases, we get better yields. So that's again not a bad thing. It's just something to be aware of. And then correlations. So why is this important for these using these worst of indices? Why are lower correlations or high correlations good or bad for SBAR, Emilio?
So here we have the rolling 3-month pairwise correlations, right, between the underliers. So we have, SPX to Nasdaq, Nasdaq to Russell, SPX to the Russell, right? Um, all the underliers that we have in the worst of baskets, right? And this is a measure of how closely these names move relative to each other, right? Um, so generally speaking, Jeff, in periods of market stress and higher volatilities, these three major equity indices will tend to move with each other, to correlate more with each other, right? And
Mhm.
the opposite is true for periods where the market is calm and just moving higher, right? These correlations become much lower, which helps, maintain a good level of premium when the volatility risk source is small, right?
Yep.
Correlations in the end are just representing uncertainty, right? So when you have lower correlations, there is more uncertainty, and therefore you get paid more for selling these puts, right? And then again, we can see in January last month how these correlations came down, which was another factor contributing to the higher premiums that we just talked about in January, right? I mean, basically market up, volatility is up, correlations down. So sort of the perfect recipe for SBAR, right? We keep getting called away on other positions, and then the new premiums are getting higher and higher, right? So an interesting month, yeah.
Yeah, so we need equity volatility for higher premium income. We need low correlations for higher premium income. And the environment that we've been in has been great for investors that have owned SBAR. Okay, so just any other comments about what you're seeing day to day, Emilio? Here's your beautiful face and a pretty awesome picture. So any other comments you want to make for the group?
No, I think we can expect more of the same, over the next few months. Like that would be a great environment for SBAR. Choppy markets, small corrections, pullbacks. We sell into them, right? The market recovers over the next few weeks. We collect the premiums, right? I think we started the year in a similar fashion, and I think that's going to continue from what I can see over the next few months, and that will be, a good environment for SBAR.
Yeah, I think we can all rest assured that Emilio and team are working hard every day, looking at the opportunity set, keeping tabs on the market, volatility, looking for opportunities to enhance yield. Just by way of a little bit of a preview of next month, Emilio and I will be talking a little bit more about XV, which is the cousin of SBAR. They're exactly the same approach. XV, Roman numeral 15, targets 15% distribution yields. We move the barrier to 25% on average. And then we'll dig a little bit deeper into XXV, which is a newly launched strategy that was launched in November of 2025. That Roman numeral is 25, so it represents a 25% target distribution yield. We're using individual stocks to put that piece of the puzzle together for investors. So stay tuned for that. We'd like to thank you for your time. Again, this is a monthly series talking about SBAR. We'll expand it to other variable option income solutions for clients. And thank you for your time, Emilio, and have a
Thank you, Jeff.